Well, next, markets are on the alert under the sharpest jump in interest rates in decades. Here to discuss the impact on African capital markets is Benjamin Boakye, who is chief economist at Second Stacks. We'll also be touching on the ramifications of the recent the downgrade of U.S. credit rating for countries like Ghana. We'll discuss if there's anything to worry about. Good afternoon to you. Thanks for joining us, Benjamin. I want to first start with this look at the trend globally. The U.S., a robust 2.4% Q2 growth led to the Federal Reserve to raise rates to 5.25% to between 5.25% and 5.5%, the highest in 22 years. Europe's ECB lifted rates 25 basis points to 3.75% as Eurozone inflation eased from 6.1% to 5.5%. In Ghana, yours truly, the policy rate rose 50 basis points to 30% amid a $1.8 billion trade surplus. Neighboring Nigeria's central bank raised 25 basis points to 18.75% to combat the persistent inflation, which is hovering around 22 to 23%. Tell us what the reason is behind the wave of the interest rate hikes we are witnessing and the effects on the global economy.
Sure. Thanks for having me. I'm sure your viewers are quite familiar with a lot of the causes of the inflation that we've been dealing with globally over the past several months. After COVID and during COVID, there were these very severe supply chain shocks, particularly out of China, and they've lingered. They haven't really gone away. And that has caused tremendous inflation to just take over in the West and also here on the continent. You also, right after COVID, had the invasion of Ukraine by Russia, and those are two breadbaskets of the world. So food inflation has been sticky in its own way, and that has also had pretty dire impacts on inflation. That's forced central banks all over the world to enter this rate hike race, as you've described, and that's pretty much where we're at right now.
Yeah, and here in Ghana, we're feeling the impact of food inflation actually resulting in the 43.1% inflation rate that we have seen in the month of July. And so in February, Second Stacks predicted that defaults and the most severe deterioration of sovereign credit have begun and will continue. I want us to look at the situation in the U.S. as we continue to look at the impacts of all these global developments on African capital markets. The Fitch downgraded the U.S. credit rating to AA+ from AAA, citing fiscal deterioration over the next 3 years and repeated down-the-wire debt ceiling negotiations that threaten the government's ability to pay its bills. And we know that when the U.S. sneezes, the world catches a cold. So how significant is this as well?
Right. Yeah, we did predict this in February. We were looking at the trend of sovereign credit rating downgrades in recent history. And we cited the United States, Ghana, and 5 other countries, which we believed were at heightened risk of defaults specifically caused by political risk. This is a situation where, your two parties in Congress or in Parliament simply can't get along. There's a lot of negative partisanship. So instead of looking ahead and forwarding off your debt issues, they're rather, fighting and bickering and preventing each other from solving their problems. So that's what happened in 2011 when the U.S. was initially downgraded by S&P, and it's pretty much the exact same thing that happened this go around with the U.S. Now, as you mentioned, typically if something as seismic as a credit downgrade of the United States, there have only been 2 in history, were to happen, you would expect a very pronounced impact in the global markets, particularly in the credit markets. But we haven't really seen that. I mean, this recent downgrade of the U.S., it didn't reflect any new information, right? Everyone was understood that there was a lot of tension in Congress and that they were going to go down to the wire before they would lift their debt ceiling. So the markets really didn't respond too severely. The way that I would say Africa needs to understand and contextualize that downgrade of the United States is that in our own country, we need to do a much better job of preventing further deterioration of our credit based on political risk. Simply put, Parliament needs to work together. Both parties need to work together. They have to have sound proposals, and they need to be decisive in their actions when they're dealing with the debt markets, because failure to do that will be punished quite severely in the markets, and particularly by way of downgrades and default, as we've seen.
Well, interesting, because I've also read around and realized, I mean, most analysts predicting that the downgrade that we have seen in the US would have little impact. We have not seen that, as you indicate. But the challenges to do with inflation and resultant hikes in interest rates, we haven't gotten a hang over. How is that affecting African markets, you think?
Well, when the Western nations raise their interest rates, we have to respond here on the continent just by way of maintaining relative interest rate attractiveness. So if they raise rates, we feel the pressure to raise rates. But I think that over here, we're raising rates simply because our inflation picture is just out of whack. So the more we can do to bring down inflation, food inflation, energy inflation, core inflation, and just ensure that price stability can remain. That'll also help with currency stability. That's pretty much what we need to do to get us where we're looking to go.
Yeah, and here in Ghana, the central bank is being blamed for the hikes that we are seeing when it comes to inflation because of the consistent hikes in the policy rate. People arguing it's food inflation. It has nothing to do with the monetary side. And so is the central bank doing something wrong?
No. I mean, look, central banks do not have an endless number of tools that they can use to fight inflation. And the primary tool that they have is the fact that they get to set monetary policy. In the environment that we're in, yes, food inflation is high, but it's not the only type of inflation that's gone up. Rent has gone up. Pretty much if you look at every category, if you look back 2-3 years, in the inflation rate, it's high double digits, mid high double digits. So they have to maintain high interest rates, and I would say that they would need to maintain a rising interest rate environment to counter the rising inflationary environment. And once you have that, you can at least expect inflation to slowly start to come down. And globally, you've seen the trend start to come down. So I would say that they need to maintain a higher interest rate posture, at least for the short to medium term.
And is there a silver lining for us here in Ghana, especially on the capital markets?
Well, the good thing, I guess, is that the capital markets aren't too impacted by inflation. When prices go up, it's the companies that are raising their prices. And a lot of these companies are what we're talking about when we say the stock market. So these are companies that are listed, they're raising their pricing, and that's, it's painful for consumers, but for a lot of them, a lot of these listed companies, they're doing okay because corporate profits are being maintained through raising of prices.
And so, what strategies would you recommend for investors based on these developments that we are seeing globally?
Well, I would say two things primarily. Number one, lean on your brokers. Your brokers are steeped in the data day in and day out. Here at Second Stacks, we're also following the markets and we're providing our research to the brokers. So lean on your brokers and take their advice. The other is just make sure you're diversified. In an environment like this, the last thing you want to do is take unnecessary outsized risks and idiosyncratic risk from having a closed off portfolio or just a portfolio that's only in one or two areas, both in terms of sectors and geographically. That could lead to some bad results. So try and stay as diversified as you can, both geographically through Second Stacks and sector wise. That would be my advice.
All right, Benjamin Boakye, Chief Economist, Second Stacks. Thank you so much for joining us here on the Marketplace Report.